Meta Platforms recently reported earnings, and let's just say the stock did not react well to the earnings report. If we take a look at the past month for the stock, it is down 10%, about $77, which equates to the stock being worth about $637. However, if we take a look at the year-to-date chart, we can see that the stock is still up 6%. So let's go ahead and take a look at the stock. Let's take a look at the intrinsic value and see if this is a good investment to add to our portfolios. Now, this is the last quarter earnings for Meta. They did beat on EPS and revenue. However, the gap, it was a miss. The reason for this is that this includes non-recurring expenses. So for example, let's say somebody bought a car that month. This is going to take into account into the EPS, but in the normalized EPS, it will not be taken into account because it's not something that happens every single month. Obviously, at Meta, they probably didn't buy a car. They maybe invested in infrastructure or something like that, but that's why this is different. Now, Meta is a stock I've been wanting to own. I just don't think that it's currently at a price where I want to buy it at. However, if you really look at the analyst ratings for this, out of a 5 rating, they have a 4.55, which is a strong buy. There's a total of 68 analysts. 49 of them say the company is a strong buy, 9 being buy, 9 being hold, and 1 sell with 0 strong sell. Now, this company does pay you a dividend yield of 0.33%. However, this dividend yield is recent. The payout ratio is only 7.19%. That's why you don't see any dividend growth, and the annual payout is going to be about $2.10 per share. Now, this isn't the actual intrinsic value we're going to be taking a look at, but this gray line here sort of indicates what the stock should be worth, and this either green or red line indicates what the price has been of the stock. As you can see, at the moment in time, we are still a little bit overvalued by about 18%. And if we take a look at the stock price compared to the EPS, as I explained before in the channel, I like to invest when there's divergence, meaning that there's more EPS, but for some reason the stock is going down. It's not the case for Meta. As you can see, the stock price has been following on the EPS. We had a drop in EPS, therefore a drop in price. However, if in the next earnings report the EPS go up and the price keeps going down, this might be very interesting for me, but it might also be interesting for me if the stock goes below $600. So let's take a look in a second about the intrinsic value. Now, I mean, Meta is a huge company. They're a $1.8 trillion company. If you could take a look at the company financials, everything is pretty much in the green, with revenue being up about 22%, net income up about 59%, and their free cash flow is up 23%. As always, we like to invest in companies that have more assets than liabilities. Meta has $303 billion of assets and only $109 billion of liabilities. And again, taking a look at the free cash flow margin, the last value was $44 billion, with the 3-year average being 40 and the free cash flow margin at 24%. Now, very important, if we take a look at the overall company efficiency, we can see that Meta has a gross margin of 82%, which means the company has great moat. They dominate a lot of the market. Net margin sitting at 30%, which is huge, especially with the size of this company. Usually a net margin above 15 or 20% is great. Now, this isn't the intrinsic value that we're going to be taking a look at, but this is a forecast that analysts have for this company. They have a low forecast of $622, an average forecast of $878, and a high forecast of $1,140, which means that this company still has an upside of about 79%. Now, if we take a look at this chart, we can see that Meta is still growing. Yes, their debt is increasing, but that's going along with the revenue. The blue line here is the revenue. As we can see, it has been steadily increasing. The green line down here has been steadily increasing as well. And while I was doing that, we can go ahead and see that the PE ratio is decreasing. This is good to happen because you're paying less for the company while it's making more money. Of course, there are other metrics that you want to take a look at, like the ones we saw before, but as we saw, those are in the green. So now you have a company that's making more revenue and you're paying less for the company. So as you can see here, the 28 times is what you would be paying for the company around here. Right now, you're paying about 27 times for Meta, but at the current price that it's at, you're going to be paying around a 25-26 multiple, which for the Mag 7 stocks, the top 7 stocks in the S&P 500, I believe this is one of the cheapest, if not the cheapest right now. Now, as we saw, yes, they have a dividend program, which is very good. They're paying us a dividend and it's a growth company, but they also have a buyback yield of 0.47%. This means that the company believes that the stock price is lower than what it should be, so they're buying back some of their shares. This is good for you as an investor. However, I do think the yield is a little bit low, and then I'm eager to see if with this price drop on the stock, the company decides to increase this and buy a lot more of its own stock. This is definitely a good sign if that does happen. So we're looking for two things here, right? Apart from the intrinsic value that we're going to look at now, we want the buyback yield of the stock to increase, and we want the stock price to decrease as well. Again, I'm not a financial analyst, but that's just my personal opinion and what I'm looking at right now. I would love for you guys to tell me in the comments below why you would invest in Meta or why you don't invest in Meta at all. And if we take a a look at some of the competition, I mean, everyone is pretty much overvalued. That's just the state of the market right now. The S&P 500 reached all-time highs not too long ago, so there isn't many opportunities in the stock market. So seeing Meta drop like this in price is definitely something to take a look at. So let's go ahead and take a look at what you've all been waiting for, the intrinsic value. Now, this is the base case scenario for Meta. It is estimated to be worth about $541, meaning that the stock is overvalued by about 15%. In the worst case scenario, the stock is worth only $380 with an overvaluation of about 40%. And the best case scenario for the stock is that it still has room to grow about 36%, meaning the stock could be worth about $988. Now, again, guys, there's different metrics for this. There's different type of intrinsic value. If you take a look on the left hand side, the discounted cash flow intrinsic value for the stock would be about 1,400. There's definitely different metrics that you could take a look at, but I still think, in my personal opinion, the stock is a little bit overvalued. I think below 600 is definitely something that I'm confident enough to open a position in this stock, maybe with a 1 or 2 shares, nothing too crazy. It's not like I have a huge portfolio, but that's just the plan for now. If you enjoyed the video, please consider leaving a like. Don't forget to subscribe, and as always, I'll see you in the next video.